Hey guys, welcome back to the channel. Whether you're trying to buy a home or consolidate debt or something like that, you're probably going to need to take out a loan to finance those goals, right? Well, if you're seeking out your first loan, know that borrowing money is a common practice and you don't need a degree in economics to understand any of it, right? Learning more about loans and the different types is going to help you make informed decisions, help take control of your finances, right? And loans are going to take many forms, but they all fall within, two common categories: secured loans versus unsecured loans. Now, whether you're approved for either type of loan depends on your credit or your credit worthiness, right? And your credit worthiness is just going to refer to how responsible you are at repaying debt and if it's worthwhile or risky to grant you new credit. So it's helpful to be aware of your credit prior to seeking out a loan just to know kind of where you stand. Now that you're kind of familiar with the role of how credit and credit worthiness is going to play in getting a loan, we're going to talk about the differences between the secured loans and unsecured loans, the advantages and disadvantages of each, and which one might be right for you. So then, what's the difference between secured and unsecured loans? Well, the main difference between them is how they use collateral. Collateral is when something of economic value is used as security for a debt in the event that the debt is not repaid. So, usually, collateral is going to come in the form of material property, a car, a house, or rental real estate, stuff like that. If the debt is not repaid, the collateral is seized and sold to repay all or a portion of that debt. So, one of the key difference here is going to be a secured loan requires collateral, while an unsecured loan doesn't require collateral. Well, what is a secured loan? Well, a secured loan requires collateral as security in case you fail to repay your debt. If secured debt is not repaid, the collateral is taken. In addition to seizing collateral, lenders can start debt collection, file negative credit information on your report, and sue you for outstanding debt. This generally makes secured loans more risky for the borrower, right? Conversely, collateral decreases the risk for lenders, especially when, loaning money to those with little to no credit history or, say, low credit or low credit worthiness, right? Less risk means that the lenders may offer some leeway regarding interest rates and borrowing limits. We could talk about some of the characteristics of a secured loan, right? So for borrowers, there's the presence of collateral, typically more risky, may require a down payment, may sell property to repay loan, generally lower interest rates, right? Longer repayment periods, higher borrowing limits, and easier to obtain for those with poor or little credit history. And then the characteristics of a secured loan for lenders is typically less risky, right? Lender can take your collateral. Lender can hold the title to your property until the loan is repaid, right? So some of the secured loan examples, a mortgage, a home equity loan, car loan, business loan, stuff like that, right? Well, what is an unsecured loan then? Well, an unsecured loan doesn't require collateral to secure the amount borrowed. Right? This type of loan is granted based on creditworthiness and income. High credit makes an unsecured loan more accessible. The absence of collateral makes this type of loan less risky for borrowers and much riskier for lenders. If unsecured debt is not repaid, the lender cannot seize property automatically. They must engage in debt collection, right? Then they can report negative credit information, right? Or, worst case scenario, sue. As a result of the increased risk, unsecured loans have characteristics that attempt to reduce the risk, right? That might include higher interest rates, lower borrowing limits, right? Let's go over some. So characteristics for an unsecured loan for a borrower, right? No collateral required, right? Typically less risky for the borrower. Qualify based on credit and income. Stricter conditions to qualify. Generally higher interest rates. Lower borrowing limits, right? So for the characteristics of an unsecured loan for a lender would be typically more risky. The lender can't take property right away if you go into default, right? And some of the unsecured loan examples, credit cards, personal loans, student loans, medical bills, right? Debt consolidation and business loans can also be unsecured. In each of these instances, collateral is not required, and you are trusted to repay your unsecured debt, right? Then we can talk about the advantages and disadvantages to consider, right? Because there's going to be some for both. So, secured loans, because when it comes to deciding on the type of loan you need, you really need to consider the advantages. Don't just go in there and say, oh, I can do this, or, I can do that. It's like, man, you really need to be looking at what it is that you need, like what's going to be best for you, right? It should always be what's best for you. So, the secured loans are going to present advantages for repayment, interest, borrowing amount, but have disadvantages regarding a borrower's risk and limitations of use. So some of the advantage would be bigger borrowing limits, less risky for lenders, usually means lower interest rates for borrowers, longer repayment periods, um, tax deductions for interest paid on certain loans. So like your mortgage, right? You get tax deductions, right? So some of the disadvantages are gonna be risky for the borrower, potential for loss of collateral, like home, car, stocks, bonds, stuff like that. Specifically for intended purpose, right? These are going to be like for your home, but here an exception would be home equity loans. Um, Unsecured loans can be advantageous for borrowers regarding risk and time, but they pose a disadvantage when it comes to interest rates and stricter qualifications, right? So the advantages for the unsecured loans are going to be less risky for borrower, useful loan if you don't own property to use as collateral, quicker application process, stuff like that, right? Some of the disadvantages: more risky for lenders, usually means higher interest rates for borrowers, hard to qualify for if you have low credit or inconsistent income, right? So, what type of loan might be best for you? Well, after considering the advantages and disadvantages of both types, it's helpful to know which one is the best for certain circumstances. Here are some common contexts in which one might be better than the other. A secured loan may be best if you're trying to make a large property purchase or don't have the best credit. A piece of property that you are purchasing can be used as collateral if you don't already own another property, right? Additionally, this loan is more accessible for you if you have low credit and may be more advantageous with lower interest rates. An unsecured loan may be best if you have high credit and a steady income. High credit helps you meet strict qualification criteria and can also help you obtain better interest rates, right? Given that this type is characterized by higher interest rates, right? Overall, secured and unsecured loans, they're each useful in different situations. Remember, the key difference is that unsecured loans don't need collateral, while secured loans do. Secured loans are less risky for the lender and may allow for some advantageous, repayment conditions. On the other hand, unsecured loans, they're risky for the lender, and they often come with stricter conditions that try to lessen that risk. It's important to make smart financial decisions, such as repaying debt on time and maintaining a good credit history. High credit is the key to getting the best conditions on any loan. No matter your circumstances, identifying which loan is best for you depends on your specific credit and goals, right? So, go over and write down what you think you would need, like what your goals are and which, what the advantages and disadvantages, like, would be good for you, the pros and the cons, right? And then you can decide from there which one you think you need to go for whatever goal it is you're trying to achieve, right? I hope you guys got some good information out of this video. If you haven't already, like the video, subscribe to the channel. Until I see you guys in the next video, y'all be safe.